Hello everyone. I hope you're doing good, mentally and physically fit and fine. Come on, friends. Now, today we move to, after completing 12 chapters, all the important questions. Now we are going to chapter number 13, and that is group audits. Guys, this is nothing but audit of consolidated financial statements. Okay, let's see, guys. Now, a few of the questions are typical and very common, very famous. Let's see one by one. The first question is about applicability of consolidated financial statements. That who is supposed to prepare consolidated financial statements? Whether it's listed entities or unlisted entities, private companies, public companies, who is supposed to do it? Who is supposed to consolidate financial statements? So it is not depend on the listed. So that's a very simple question. There is nothing like case study. Simply they are asking who has to make it. That's the question they are having. So answer is pretty simple, straightforward. Answer is pretty simple, straightforward. We have section 129 of Companies Act, and subsection 3 says that all the companies who are having subsidiaries, and subsidiaries include joint ventures or associates, okay, all of them are supposed to prepare consolidated financial statements. So if you're having subsidiary, if you're having joint venture or associate, you are supposed to prepare consolidated financial statements. As simple as that. As simple as that, nothing to worry about. So in this case, they were asking whether unlisted company is supposed to make consolidated financial statement. Of course, yes. They are supposed to make consolidated financial statements. You give reference of section 129 subsection 3. And then this was not required, but this is extra. 129 subsection 4, mutatis mutandis. What is that? They will have to prepare their consolidated financial statements will have to be prepared just like standalone financial statement. Mutatis mutandis, all the concepts, all the formats, all the requirements, audit requirement, everything which is applicable to standalone financial statement, same thing is going to get applicable to consolidated financial statements also. Okay. Then how they should be prepared? How they should be prepared? It's very simple, straightforward. They should be prepared as per the instructions given in Schedule 3. And as per instructions given in Schedule 3. And Schedule 3 says that you are supposed to follow Ind AS or AS as the case may be. So ultimately Schedule 3 talks about Ind AS or AS as applicable. Okay. So if problem is silent, we can think about Ind AS, and if they specify AS, then we have to go with the AS only, guys. Because answer as per both, especially in case of exemption, it is going to change. If any of the subsidiary is not consolidated, if any of the subsidiary is not consolidated, then details has to be given in notes to accounts. Details have to be given as per Schedule 3. Details need to be given in notes to account that this is the name of the subsidiary and it is not consolidated. What is the reason? We need to explain that. Very simple. There is one exemption in Companies Act. One exemption. A very simple. This is the exemption of intermediary subsidiary. So suppose we have A Limited, we have B Limited, we have C Limited. So A is holding, B is say B is a subsidiary, again C is a subsidiary, and B is a intermediary subsidiary. So very simple thing they have specified. They have specified that in case of A, see, B is having a subsidiary, so B is supposed to prepare B plus C. A is having subsidiary B and then sub-subsidiary C. A is supposed to prepare A plus B plus C. Consolidated financial statement. So as you are preparing A plus B plus C, it is covering both the entities and you are informing it to ROC why to prepare financial statement of in between group B plus C, because you already have A plus B plus C, which is ultimately going to go to ROC. So they are saying, okay, let's not do repetitive work. Let's exempt intermediary subsidiary. So they have given a very simple thing. So that suppose there is an intermediate subsidiary. It can be wholly owned, or it can be partly owned. It can be wholly owned or it can be partly owned. Okay. That intermediary subsidiary can go for exemption they can go for exemption. They need not prepare consolidated financial statements. But then there are for certain conditions. Condition number 1, it should not be a listed company. It should not be in process of listing. It should not be a listed company. It should not be in a process of listing. And they have informed all their members that we are planning to take the exemption. We are not going to prepare consolidated financial statements. No one takes objection. And their holding or ultimate holding company, it has submitted the financial statements to ROC. If that is the case, they can claim exemption. No need to prepare consolidated financial statements. So very logical, very simple conditions are there. Okay, guys. So in this case, the question was whether unlisted entity is supposed to prepare. Of course, unlisted entity is supposed to prepare. So you can give very simple. What are the things you're supposed to highlight in the answer? First, 129, first requirement. Okay. Who is supposed to consolidate? How they are supposed to consolidate? Mutatis mutandis, as per Schedule 3, which ultimately talks about AS Indias. So we simply explain who is supposed to consolidate, how they are supposed to consolidate, and who is exempted. You simply focus on 3 things. Who is supposed to consolidate, how they are supposed to consolidate, and exemption. Okay, guys. So that's it. Nothing very special about it. But then they are very fond of the applicability. They are very fond of applicability question that you are going to understand as we go ahead. Then let's talk about exemptions. Very simple. So exemption, when we talk about exemption from consolidation is given in Companies Act. We have just seen that there is an exemption from Consolidation Companies Act to an intermediary subsidiary. Apart from that, there are exemptions which are given in accounting standards, and there are exemptions which are given in Ind AS also. So exemptions are given in AS also, and exemptions are given in Ind AS also. Okay, let's see those exemptions, guys. Let's see these exemptions first, because there are few questions now based on exemptions only. So we can say the big exemption is as per law. We already discussed exemption under Companies Act. There's an exemption under Companies Act. We have seen that intermediary subsidiary is not supposed to prepare consolidated financial statements. Exemption from preparing consolidated financial statements. Then, so we have seen the condition. It is a wholly owned or partially owned subsidiary. It's a subsidiary, partially owned subsidiary, and no objection from anyone. It is not in listed or process of listing, and ultimate holding company, ultimate holding company, any one of them, they have already filed consolidated financial statements. Now, next is exemption under Ind AS. Exemption under Ind AS. So already seen Ind AS 110. Ind AS 110, there is an exemption. Sir, what is the exemption under Ind AS 110? Okay, just a minute. A very simple exemption under Ind AS 110. Investment entity, there's exemption given to investment entity. So, suppose we have an investment entity, then that investment entity is their regular business to invest money. They have not invested money to control companies and run business. They have simply made investment just to provide finance. So, but then they have. So, for that entity is an investment entity. If they have raised funds from one or more investors for specific purpose for providing investors with investment management services. So their business model should be they are raising money from people and they are giving investment management services. They should clearly specify that we have taken this money, we are going to invest, that is our basic purpose, and returns, the sole purpose is to invest money to generate returns in the form of capital appreciation or investment income or both, and provide returns to you. Then they are measure and evaluate performance substantially, and all the investments are measured, valued at fair value basis. They are following fair value basis for valuation of their investments. Okay, so very simple thing, guys. Entity will be considered investment entity if they have raised money from the investors and they have committed to for investment purpose. They are committing that they are going, this is solely for purpose of investment, they are going to generate return in so and so forms and provide return to the investors, and they are measuring their investments substantially on fair value basis, then that entity will be an investment entity and they are not supposed to prepare. So there was a question in exam about this. They are not supposed to prepare consolidated financial statement. So intermediaries are not supposed to prepare consolidated financial statement. Investment entity is not supposed to prepare consolidated financial statements. Then along with that, let's see this also. There is a paragraph 33 of Ind AS 110. However, as per paragraph 33 of Ind AS 110, the parent of the investment entity shall also consolidate all entities that it controls, including those controlled through investment entity, unless the parent itself is an investment entity. So that what they are saying. Suppose investment entity is having a parent, they are supposed to prepare consolidated financial statements, including all the subsidiaries and sub-subsidiaries. But if it is proved that even it is an investment entity, even they are not supposed to prepare consolidated financial statements. So what they are saying, suppose in our example, B Limited is an investment company, so they are exempted. They are exempted from preparing consolidated financial statements. But what about A Limited? In case of A Limited have to prepare consolidated financial statement including B, P, because PQR are sub-subsidiaries, PQR, B, C and D, everyone. But if it is proved that even A is an investment company, even they will be exempt. So, whether holding company will prepare consolidated financial statement depends whether they are investment entity or not. Okay, guys. So, we have seen exemption as per Companies Act. We have seen exemption as per Companies Act. We have seen exemption as per Ind AS. Now, one more exemption, that is exemption as per accounting standards. There are two exemptions as per accounting standards. Two exemptions are there. Two reasons. One is temporary holding. If the shares as per accounting standards, if you know that for small companies accounting standards are applicable. So in accounting standards, if the investment is hold for temporary purpose, if investment is hold, see, you must be having your concept notes, guys, so you can use that. If the investment is hold for temporary purpose, and it will appear that it will be said that it will be sold in the short term, it will be sold within few months, it is stock in trade. If the investment is held for short term purpose, there is no long term reason, then no need to consolidate such subsidiaries. No need to consolidate such subsidiaries. Don't do consolidation of such subsidiaries. Okay. If there are severe long-term restrictions, repatriation of money of economic benefits is not possible. For example, our company is in Ukraine, and because of war and a lot of restriction, it is not possible to give economic benefits back to the holding. As you are not going to get economic benefits, why you are trying to show it as your strength, as your asset? Don't consolidate them. So if there's a temporary holding, don't consolidate them. If there are severe long-term restrictions, it will be difficult to get the benefit, economic benefit from there. Don't again consolidate them. So there are two exemptions exclusively in accounting standards. Okay. As an auditor, you should always see whether there is any exemption, and there should be positive evidence supporting the exemption, whatever conditions. Whether it is exemption to the intermediary subsidiary, exemption to the investment entity, exemption, index exemption, or accounting side exemption. There should be evidence to prove that these exemptions are valid, genuine, and it's available for the company. You have to give reasons in notes to account for all the entities which are exempted, which are not consolidated. Write the name, give the reasons why they are not consolidated. Okay. Now we know exemption as per Companies Act. Now we know exemption as per Ind AS, and now we know exemption as per accounting standards. So there are three types of exemptions. Okay. There is one exemption of Companies Act, one exemption of Ind AS, and two exemption of accounting standards. Now, there is a 51% voting in S Limited. However, it holds disclosed that shares are stock in trade. Shares are stock in trade. Very interesting thing. Stock in trade means temporary, very important. Stock in trade means shares are there for temporary purpose. In financial statements, since the shares are held exclusively with a view to their subsequent disposal in near future, for they are specifying in near future they will be disposed of. R limit represent disposal in near future, represent that while preparing consolidated financial statement, S can be excluded. They are saying that S Limited can be excluded from the consolidation. As an auditor, how would you deal when the consolidated finance are to be drawn up in compliance with Ind AS? Okay, so there are still two questions. Number one, they are saying that we have a subsidiary, shares are with us, but they are for temporary period. It's stock in trade. We are going to dispose it off. So tell us, can we go for exemption? Can subsidiary be exempted from from the consolidation purpose? And what will be the answer if it is Ind AS? So that's the most interesting point here. As per accounting standard, you have two exemptions. Exemption number one is temporary holding, and exemption number two is severe long-term restrictions, not able to repatriate any economic benefits, give back any economic benefits. And there is one exemption in Ind AS, that is investment entity. Now here, they are saying what will happen if it as per Ind AS. So they are indicating that we have to answer as per AS and Ind AS both. So you say that as per AS, there is a exemption of temporary holding. So if you are preparing consolidated financial statement as per accounting standard, you will get the exemption. But as per Ind AS, There is no such exemption. In India, there is no exemption of temporary holding. There is no exemption of temporary holding. In India, there is no exemption of severe long-term restrictions, repatriation of economic benefits. No. There is only one, that is investment entity. So they will not get exemption. They will not get exemption if the consolidation is done as per India's. So if you go with AS, exemption will be there. If you're going as per India's, exemption will not be there. That's the crux, that's the key, that's the important thing. I hope you are clear about this. I hope you understood the most important thing. So it was coming back to back, May 19, November 19 exams. Then there was schooling after that. It is there in the new study material. It is there in the new study material. So it's very simple. They have specified a lot of things. No need to. So you can simply say that, okay, that consolidation is required. Everyone need to consolidate as per section 129 subsection 3. How the consolidation should happen is as per schedule 3, and it talks about Ind AS and AS as the case may be. So you give basics of consolidation first, and then 2 exemptions of AS. 2 exemption of AS. As per AS 21, there are 2 exemptions. Talk about that. And in Ind AS, there is no such exemption. And then you answer. If you're consolidating as per AS, you will get the exemption. If you're consolidating as per Ind AS, you will not get the exemption. Okay, the interesting point. So guys, as I said, it's their favorite topic about the applicability and exemptions. So we have seen question of applicability, we have seen now exemptions, we have seen the questions. Now they are repeating the same concept in different forms now. And now what if they are silent, whether to use AS and Ind AS? I will say that answer as per Ind AS and also give answer as per AS also. It's not a very big thing. Now again they are talking about stock in trade. Again they are talking about stock in trade. And they're not talking about AS or Ind AS. So answer as per Ind AS and then also give answer as per AS also. So they're talking about stock in trade, that means temporary holding. Then they're saying that 20% of the shares were sold in near future. Again, that means temporary holding. Again, that means temporary holding. Again, stock in trade. So you'll say that, give the basics, applicability of consolidation, it should happen as per schedule 3. You talk about AS, you talk about Ind AS. Then you say that, so I will say that cover both the aspects. As per Ind AS, no exemption, consolidation should be done. As per AS, there is an exemption, consolidation did not be done. It's a very famous, very repetitive question, guys. Everything is on the same lines. Again, they are repeating. All these questions are coming from study material. They had 65% shares, but then after year end, 25% were sold. Again, it indicates. Okay, this is similar. Now, November 23 RTP, they have exclusive question for, okay, for investment company. Exemption. As I said, guys, we are simply, once you know the exemptions, then you can simply answer all these questions accordingly. So they are giving example that it has invested 25% in one, 50% in one, 60% in one. They're saying that it is an investee company. So they're giving all the hints. They're giving all the hints that there's a company which has raised money from the investors and they have promised returns to them. They're managing their investment. They're investing their money into a lot of companies, giving all the hints. Now, section 129, there is no exemption, but then in India there is an exemption. In India there is an exemption. Again, explain the applicability, talk about how to do exemption as per Schedule 3, talk about India's, India's 110, explain the investment entity and explain they will get exemption. They will get exemption. Investment entity did not prepare consolidated financial statements. Investment entity did not prepare consolidated financial statements. Okay, so it is on the same thing, guys. It's the same concept. It's a lovely concept. Now we have discussed applicability. We have discussed exemption as per Companies Act and its cases. We have discussed exemption as per AS, its cases. We have discussed exemption as per Ind AS and its cases. And this is a controversy. Initially, it was first asked in November 18, and there was a wrong answer. There was a wrong answer, and then we put a mail that please rectify the answer, and they rectified it. But then that's an old story, guys. So now next thing is pretty interesting. Control can be there. Control can be there because of equity shareholding, and control can be there if you control board of directors. If you control board of directors. So control can arise because of two things, guys. It can happen because of equity shareholding, and it can happen because you are controlling board of directors. So suppose this A Limited, B Limited, C Limited, it is holding, A Limited is holding 80%. Say 90%, 10% with B Limited. But B Limited is controlling board. Suppose they are technology providers, and it is saying that technology providers, more than 50% of the board will be appointed by B Limited, or directors will be nominated by B Limited. Either appointment is in their hands or nomination is in their hands. So here, because of equity share, A Limited is controlling C Limited. Because of board, B Limited is also controlling C. Now the question is, where consolidation will happen? Whether C will consolidate with A Limited or C will consolidate with B Limited. Whether A Limited or B Limited. Answer is pretty simple, straightforward. But with both, consolidation will happen with both. A Limited also and B Limited also. In case of A Limited as per 90%, in case of B Limited as per 10%, consolidation will happen at both the entities. Don't worry, the percentage is different. Percentage is different, 90% and 10%, but it will happen in both. That's interesting. So, if there is a situation that there is a control over composition of board, okay, board of directors, then as an auditor, what are you supposed to check? What aspect you are supposed to check? What things you are supposed to evaluate? It's pretty simple, guys. So if you come across a situation where there's a control because of control over board of directors, so first we'll explain that, okay, consolidation will happen at both the entities where there is control because of equity shareholding and where there is a control because of board of directors. Very rare situation, very unique situation that such thing happens. But if such things happen, consolidate in both the cases. As auditor, first we'll obtain the understanding. As auditor, first we will obtain the understanding. Very simple thing. For understanding the accounting policies of parent, subsidiaries, associate, program, nature, time, extent of audit process to perform. First, understand the whole group. Understand the whole group. Who is the parent? How many subsidiaries are there? How many subsidiaries are there? Associate, joint ventures are there. Understand that. Okay. Understand policy and procedures of the holding, policy and procedure of the group. That understanding of the group and understanding of accounting policies must. Then, if there is a unique situation of control over the board, you need to check that. You need to understand this control. This control is coming up because of technology contract or finance contract or some resource contract. How come this control is there? What is the root cause? What is the base? Which contract is the base of that? Go and understand, read that contract and understand whether there is a real control and check whether there is a real control. First, understand the situation and the group, then understand the control over board of directors. Is it genuine? Is it proper? Then you go and check whether proper consolidation is being done, proper adjustments as per AS India's proper consolidation adjustments. Whether addition, line by line addition is done, consolidation adjustments are done. We're supposed to check that. Very simple thing, guys. For obtain understanding, then you focus on about the control, then you simply go and check the consolidation, proper consolidation, and it being a related party. These subsidiaries and joint venture associates ensure that accounting was done properly as per AS 18. It's an old question, so they have given reference of AS. You can give reference of Ind AS also. Give reference of SA 550 to deal with related party. And ultimately, if you feel that everything is fine, if you feel that it's a proper group, it's a proper control, it's a proper consolidation, they have complied with accounting standards, we have followed the SA 550, we draft the opinion. Okay, whether it is giving true and fair view, it's a fair presentation, or is it as per compliance framework? As per framework, it's a compliance framework. Okay, so guys, nothing very new, nothing very special. Now, so we have seen a lot of cases of applicability and exemptions and unique case of control because of control over board of directors. Okay, guys, they are very interesting cases, very easy cases. If such cases come, you should not miss any mark from this particular chapter. Let's see, guys. Now, next is, just a minute, guys. Now, next is permanent consolidation adjustment. N number of time it has been asked. See the repetition, how many times it has been repeated here or there. Permanent consolidation adjustment. And then we have current consolidation adjustment also as well. Okay. Let's quickly give you an overview of what is permanent consolidation adjustment. So when you read FR account financial reporting, you don't hear such terminology. What is permanent consolidation adjustment? What is current consolidation adjustment? What are it? When holding company acquires controlling interest, and the first year in which consolidation happens, a lot of adjustments are done. These adjustments are simply carried forward to the next year. They are not done again and again. Let's freeze, guys. After acquiring controlling interest, in the first year of consolidation, some calculations and adjustments are done. Goodwill and capital reserve is computed. Now, these calculations are not required to be done, generally not required to be done again and again. They're simply carried forward from one year to another year. They are called as permanent consolidation adjustment. Permanent consolidation adjustment. Let's see, guys, what are permanent consolidation adjustment. So first you first simply define. So adjustments which are generally done in the first year of consolidation, the first time the financial statement are consolidated, they are called permanent consolidation adjustment. For permanent consolidation adjustment, okay, GM, General Manager, meets SP, Superintendent of Police. So for the purpose of consolidation, GM meets SP, that we want to do consolidation. Okay, please help us out. Please give us adequate security. Now, G stand for goodwill and capital reserve. So in permanent consolidation adjustment, the most important thing is computation of goodwill and capital reserve. So you see here, while computing goodwill and capital reserve, you see what is the net assets. Goodwill and capital reserve is calculated in a way. Goodwill and capital reserve is calculated in a very unique manner. Here we see how much money is invested. What is the cost of investment in a particular subsidiary, in a particular entity? Okay. So we have cost of investment. Now you must be aware about consolidation. We have cost of investment. Just an additional thing, and you are aware, if there's a pre-acquisition dividend, if there's a dividend of pre-acquisition period, we adjust with the cost of investment. So for computing goodwill and capital reserve, we need cost of investment. Generally, this cost of investment is adjusted if there's a pre-acquisition dividend. If the dividend of the prior period is there, even if that is adjusted in the cost, then you find out the net assets. Then you find out the net assets of the subsidiary with the help of capital and reserve balances. So you find out what is the share of what is share capital, what is our share of share capital, what is our share of capital profits, or say pre-acquisition profits. We take that. With the help of that, we get net assets, and then we adjust it. Cost of investments minus our share of share capital, our share of capital profits. That is nothing but capital plus profit is nothing but net assets, and you get difference, goodwill or capital reserve. Okay. Now, if there are multiple subsidiaries, you will get multiple goodwills and capital reserve. If the cost of investment is more, if the cost of investment is more than our share of share capital and capital profits, you are going to get goodwill. If the share capital and capital profits are more, pre-acquisition profits are more, you are going to get capital reserve. Okay. There is an option. They can opt to net it off and show the net goodwill or net capital reserve. You can do that. And if they do that, they need to give breakup in notes to accounts, that this was the goodwill from so and so subsidiary, this was the capitalism from so and so subsidiaries, and it was netted off, and a net amount was written. So you have an option, either you net off or show separately. Both the options are there. So the most important thing you will talk about is goodwill and capital reserve calculation. Then you talk about minority interest. So part of the capital belongs to minority, part of the capital profits belong to minority, and from there you compute the minority interest. So we have to see whether minority interest proper percentage is taken, it's computed properly. Okay. Then subsequent changes in permanent consolidation adjustment. Now, generally, as said, it's a permanent. Generally, year on year it remains same. But then, sometimes it's going to change because of change in shareholding. if there is subsequent increase or decrease in the shareholding, because of that, adjustment need to be done in goodwill and capital reserve and minority interest. Then pre-acquisition reserve, that's also called capital profits. Part of the profits which belong to pre-acquisition reserve is a very important thing, because when we compute goodwill and capital reserve, we deduct our share of share capital, our share of pre-acquisition reserves. Okay, so we need to check whether it is properly computed or not. Its calculation should be checked properly. So when it comes to permanent consolidation adjustment, first we'll give definition. What are these permanent consolidation adjustment? Then you are supposed to explain GM meets SP. G is for goodwill and capital reserve. Then M is for computation of minority interest. Then you talk about subsequent changes. Then you talk about pre-acquisition reserve computation. Okay. So guys, now these questions can be a little bit twisted. They can make a case study out of it, but the content and concepts are going to remain same. Simply, they can make a case study, nothing else. Now, what is responsibility of parent? So there can be a question, what is parent entity, holding entity supposed to do about consolidation? What are their responsibilities? Let's see guys, it's very simple. So as a holding company, the first thing is to sit with the investment register and contracts and agreements and find out how many subsidiaries we have, how many entities are there on which we have control. Identify the subsidiaries, identify joint ventures, identify associate. So sit and first identify subsidiaries, joint ventures and associates. Identify the components and make its list that these are our components. This is the kind of relationship we have with them. This is the percentage holding we have with them. Next step is, once you identify the components, we are studying what is responsibility of parent. So first responsibility to sit and to identify the components they are having. Next is parent's instruction. Next is parent's instruction. Okay. So it is parent will be giving a lot of instruction to all these components. That listen components, for the purpose of consolidation, we are going to need balance sheet and P&L of so and so period, so and so date. Give them instructions. Further, we are going to need balances of so and so date, because as per date of acquisition. We are going to need balance sheet P&L of so and so year. We are going to need balances for date of acquisition. For date of acquisition is not available, then the opening balances. So we are going to ask for date of acquisition balances or opening balances. We are going to need the value of for the purpose of revaluation. We are going to need value of the fixed assets on the date of acquisition. We need revalued amount on the date of acquisition. We are going to need information about intercompany balances, intercompany transactions, intercompany stock. Okay, so we are going to need all this information. A complete list will be given, that all this information will be required from you guys. We'll obtain the financial information. We want to know, these are our accounting policies. For which accounting policies don't match, specify that also. Obtain financial adjustments, all the finance. So first is identify the components. Give them instructions. Collect all the financial information. See if it's complete, it's appropriate. Then you start doing one by one. Then you go for gap conversions. So you need to adjust that information. Maybe because the financial reporting framework is not same. We are working on Ind AS, they were working on AS, so some adjustment will be required. Then for harmonization of accounting policy, some adjustment will be required. Finally, we will go for consolidation adjustment, permanent consolidation adjustments and current consolidation adjustment. Current consolidation adjustments means those adjustments which are done for every time we go for consolidation. Every year those adjustments will be done. Then finally, while preparing notes to accounts, we need to understand segment reporting. When an individual company was there and only one business was there, segment reporting was not required. But as you go for consolidation, a lot of different businesses are going to come together. Segment reporting will get applicable and we have to give segment wise information. Then related party disclosure. Before consolidation, there will be a lot of related parties. But then as you consolidate, some related parties will go away because of consolidation, they will go away and some new related parties may arise. So that disclosure is very important, critical, that it should be made properly. It is not simply 1 plus 1. We need to be alert. Some of them will be eliminated. Some of the new parties may come up. So this is the responsibility of the parent. Okay. Identify components, give instructions, get information, first do gap adjustment, then do harmonization, then do consolidation adjustment, at the end go for segment reporting. And guys, see, it's in a flow. If you remember this in a flow, you will remember it for a long time. Step by step, step by step, step by step. Now, May 22, a very interesting question is there. Very interesting question. So, there is a holding company T Limited. It's holding 68% shares of B Limited, 51% shares of C Limited. It is having two subsidiaries, B and C. And now we have auditors RS and Company auditing the holding company. And we have one more auditors of subsidiary companies, B and C. The issue is they have qualified. Audit report for one of the subsidiary is qualified. While framing the opinion consolidated financial statements, now principal auditor ignored the qualification, saying that it is not material at group level. Comment about it. Comment about it. So this is a very beautiful, wonderful concept, and we need to understand this concept. Role of SA 600 and guidance note on consolidation. Role of SA 600 and guidance note on consolidation. So you're supposed to say that we have SA 600 which tells principle, which tells audit, which explains what should be the relationship between the principal auditor and the component auditors. If we talk about standalone financial statement, branch auditors are the component auditors. If we talk about consolidated financial statement, auditors of subsidiaries, joint ventures and associates, they are our component auditors. Okay. So first explain that in case of consolidation, SA 600 is applicable. It is applicable because there is a principal auditor, there are component auditors. It tells roles and responsibilities of both the auditors and how they should deal with each other. Okay. So SA 600 is applicable in consolidation. You should also explain that guidance note on consolidation is specifically prepared for consolidation, even that is relevant. So when consolidation happens, SA 600 is also relevant and applicable, and guidance note on consolidation is also applicable. And now what they say that if the audit of standalone financial statements is happening, okay, if the audit of standalone financial statements is happening, audit of component is happening, then Now, let's see guys. So while doing audit of component, a separate materiality for standalone financial statement will be there. Principal auditor may compute materiality for each component and communicate to the component that I will suggest that use this materiality level when you are doing audit of standalone financial statements. When you're doing audit of standalone financial statements. So first explain SS 600 is applicable, guidance note on consolidation is applicable. Then you explain that, okay, principal auditor can help components for materiality for standalone financial statements. Then you explain that, now this is very important, group level materiality level should be computed for the group level, for the group as a whole, and then you explain the uses, that this materiality is used for scoping. A group level materiality will be computed, and when you have to decide which component should be audited, which component should be focused on, and which component should not be focused on, okay, that is, which should be covered in the scope and which should be excluded from the scope, group level materiality should be used. Group level materiality should be used for scope in and scope out. Further, group level materiality should be used for checking consolidation adjustment, that is permanent consolidation adjustments and temporary consolidation adjustment. Group level materiality should be used. Then, okay, that's very important. Then when you deal with them, you can get the confirmations from them that they are independent, they are ethical, they are independent, and they have complied with important. They have seen compliance of important accounting standard. They have followed standards on auditing, and the most important thing, modifications and EMP OMP. If there are modifications or EMP OMP in the components, then we have to check the materiality. That's very important. We have to check the materiality. If they are material, we include the materiality at group level. With the help of group level materiality, we need to understand that. If they are material at group level, they are included in the audit report of the parent. So depending on that. So it's very simple, guys. Let's understand. So you need to explain the applicability of SS 600. That is the fun thing. They need to explain materiality at standalone level can be computed and communicated with the parent. Follow that. Then materiality at the group level, you need to explain, and then the usage. 3 points are connected. These 3 points are connected. Materiality at standalone level, materiality at group level, and usage of that group level materiality for scope in, scope out, and adjustments. Okay. So first we talk about applicability, then we talk about materiality, then we talk about confirmations, and finally we talk about how to treat with modifications. That's a very important thing, guys. So explain all of them, and ultimately discuss the case and give conclusion that it is going to depend on the materiality of the matter. If it's material, include it or exclude it. Okay. So that was interesting, guys. That was important. Then the next is written representations. Guys, these are very simple, straightforward question. They have not twisted it. They have not twisted these questions. But sometimes they may twist these questions and make them case study oriented. So if you have a very good understanding and good retention, even if they twist it, you will be able to identify it, understand it, and give good answers for them. Okay. Let's see, guys. Now, So when you are auditing consolidated financial statements, you take written representation. You take written representation, management representation. What matters, what specific matters you will have in that written representation. It's a study material question, guys. What specific matters? Let's see. So you explain that when audit of consolidated financial statement is happening as per SA 580, for audit of consolidated financial statement, written representation should be taken. One written representation is mandatory regarding management's responsibility of preparing consolidated financial statement. You have to take that written representation. Apart from that, if there are any material items and we need some assurance, we need support, we can take more written representation. So you explain applicability of 580, you explain mandatory written representation, you explain written representation can be taken for other matters also. Now, what things should be there? What things should be there? 4 things. SCAR. Okay. We are going to ask written representation for SCAR. There's a scar. There's a scar on the face. So we are going to ask a written representation for that. So S stand for segment. When we prepare consolidated financial statement, segment reporting is made. Segment reporting is done. So we are going to ask written representation from the management that give it to us in writing. Give it to us in writing, guys. Give it to us in writing about segments. Please give it to us about writing about segments. How you have identified business segment, geographical segment, what was the basis, and confirm it to us. And confirm that these are the only business segments, they are the geographical segments, and what is the reason behind they being reportable segment, how many segments are put in others. So we want a detailed written representation about how management has thought about and decided about segment reporting. Then C stand for completeness. We want a written representation from the management that there is a completeness. They have covered all the subsidiaries, joint venture, associates. No component is left out. No component is left out. We want a written representation for that also. Then A for adjustments. We want a written representation that about permanent and current consolidation adjustment. These are the only adjustment, is a complete list. There is no other adjustment apart from that, and these are at appropriate amount and they are in appropriate manner they are adjusted, including intra-group transaction, intra-group balances, stock, intercompany stock, and so on. And finally, about related party. So we want written representation why there is a scar. S for segment reporting. S for segment reporting. C for completeness of the components. Nothing is left out. No component is left out. A is for adjustments and R is for related party. So guys, these are lovely questions, important questions. They may come for 5 marks. Now this question has been repeated again, a lot of time about reporting. And it covers a lot of different situations. Let's see, guys. It's very simple. It's a very simple concept about the reporting. Different situations can come up. So they've explained the group. Different situation will come up. If parent company's auditor is also auditor of all components, so the auditor of the parent company and all the component is same. Or parent company auditor is not the auditor of all components. Some auditors are different. Or next situation, the accounting framework of the component is different. We are using India's they are using something else. They are using AS, they are using US GAAP, they are using something else. Components are using different framework, accounting framework or auditing framework. We are using standards on auditing. They are using international standards on auditing or some other regional standards on auditing, or some of the components are not audited. So different situation, 5 different situations may arise. And there's a very specific case they have covered here, very specific, that there's a group and in which component is audited by someone else. So how reporting will happen? That situation is already covered. So they may ask either of the situation. There are 5 situations which arise. Now, let's see guys, let's talk about reporting. Situation number 1. That auditor of the holding company, auditor of the holding company and auditor of the components, auditor of the holding company and auditor of the components, they both are same. They both are same. Okay. So it's a very simple and straightforward situation. What is the responsibility of the parent company's auditor in this particular case? His overall objective remains same. He is going to tell, he is supposed to talk whether consolidated financial, in case of reporting, when the parent auditor is going to report, he is simply supposed to report whether the parent company's financial statements are as per applicable financial reporting framework. As per applicable financial reporting framework, whether it is AS, Ind AS and Schedule 3, if it's a fair presentation framework, he is supposed to go one step ahead and also tell whether financial statements give true and fair view. So if only if the auditor is same for the parent as well as whole group, a very normal reporting is going to happen. Very normal reporting is going to happen. A very simple and normal reporting will be done. Okay. So don't worry about that. The very simple thing, simply explain our overall objective, nothing else. He is supposed to report as per overall objective, nothing else, no change, same to same. What if some auditors are different? What if some auditors are different? In that case, SA 600 will get applicable. In audit report, we are supposed to explain that some of the components are audited by some other auditor. We need some other auditors. We need to quantify revenue, profit and net assets of those components. And for this, we are going to put OMP, other matter paragraph. And we are going to explain that without modifying our opinion, we would like to draw attention that so and so components are audited by someone else. This is their revenue, this is their profit, this is their total assets. So don't worry about it. Okay, simply put OMP, it's done. So if the person is same, simple report as per overall objective, nothing else. If some people are different, simply put OMP and it's fine. So first 2 cases are very simple, straightforward. The next is now accounting framework is different. So 1A, 1B, 1A is same auditors, 1B is different auditors. 2A is different accounting framework, 2B is different auditing framework. And finally the last one is what if audit is not done? Now let's understand this, guys. What if there is a different accounting framework? Okay. Suppose we have a subsidiary in US and they have different framework altogether than as compared to India. What will happen? There are 2 options available. Option number one is very simple, straightforward. So financial statement of the subsidiary will be received in India. Okay. Now they are received in India. Parent companies, the parent company and its team, will first of all convert, if it's the foreign currency involved. Let's not talk about foreign currency. If it is involved, we'll do the foreign currency conversion also. If there is no foreign currency conversion, that's fine. The most important thing is there will be a gap adjustment. Parent company team will do the gap adjustments. They will adjust incomes, expenses, assets and liability, to shift from the old framework to the new, to shift from the different framework to the framework which parent company uses. So those adjustments will be done by the parent company's team, and adjusted financial statement of the component will be prepared. Now these adjustment will be audited by the parent company's auditor. These adjustment will audit parent company auditor. Adjusted financial statement will be audited by parent company auditor. And then consolidation will happen. And consolidation will happen, and parent company auditor will audit that consolidation also. So guys, the option number 1 is bring financial statement to India. You only do all the adjustments and then do consolidation. Auditor will first audit the conversion adjustments, converted financial statements and consolidation adjustments as well. Everything will be done by the parent company and its parent auditor. There's one more option. We'll ask component auditor, you only convert, you know your company well, you only convert, adjust your financial statement to bring it in line with the holding company framework. You only do all the adjustments. You only prepare adjusted financial statement, and your auditor will do audit of these adjustments and adjusted financial statements. And you send the adjusted financial statement and report to India, to the parent company, to the holding company. Parent company will only do the consolidation adjustment and parent auditor will only audit the consolidation adjustment. That's it. So 2 options are available. In option number 1, parent company and its auditor will have to do a lot of hard work. Their workload will increase. In option number 2, their workload will decrease. In practical life, generally, option number 2 is preferred. Guys. Okay. So this particular part is more about the procedure than the reporting. Okay, but then the final reporting will happen as per framework of parent company. Work may be done by the parent and its auditor or component and its auditor. What if there is a different auditing framework? Now in India, we have Indian generally accepted auditing standards. That is nothing but standards on auditing. And suppose they are using different framework altogether. So we'll ask component auditor that, listen, you prepare a separate report that you have audited. You prepare a separate report that you have done your audit as per Indian gas, as per Indian standards on auditing also. So we want to audit report as per Indian auditing standards also. If you give it, that's great. Otherwise, we'll consider that this component is not audited. Now, what if components are not audited? It's very simple, guys. Yes, it may happen that is not audited. then in case you have to see what is the materiality of that component. If that is not very material thing, a very small thing is there, you may put a OMP and explain these are small component hardly contributing to so much of revenue and profits and assets. We put a OMP, alert everyone, it's done. Or if it's material, if a material thing is not audited, then that's a problem thing. We have to modify the opinion. We have to modify the opinion. We have to qualify and say that, okay, such big components are not audited. We qualify it because they are not audited. It's lack of sufficient appropriate evidence. Because they are not audited, we don't know whether we can rely on them or not. There can be possible misstatements in those components. Let's freeze, guys. There are 5 situations. 1A, 1B is the same auditor, different auditor. 2A, 2B, different accounting framework, different auditing framework. And 3, very simple thing, not audited. All depends on if the component is material or not material. If it's material or not. It can be twisted, and they may ask you as a case study, guys. Now, let's understand it is on the same things, some simple case study, on the same knowledge, some simple case studies are there in study material. Mr. M.V. Chitra is the auditor of consolidated financial statements. Financial statement of 8 subsidiaries. There are 8 subsidiaries in the group. Such financial statement, financial information and auditor's report of subsidiary have been furnished by management of D and D Limited. The following further information. So there are 8 subsidiaries, and these 8 subsidiaries are audited by other auditors. And they have total assets of so much, total revenue of so much, net cash outflows of so much. 2 of these subsidiaries are located outside India, whose financial statements have been prepared in accordance with accounting principles generally accepted in their respective countries, and which have been audited by other auditors, generally accepted under generally accepted auditing standard applicable in their respective countries. Where and how such information should be included in independent auditor's report on consolidated financial statements. Also draft a suitable para. So guys, so basically there is a question that some of the entities are audited by someone else. The situation 1B, some of the entities are audited by someone else, we have to put a OMP. So you explain division of responsibility, you explain SS 600, you explain SS 706, division of responsibility and putting OMP. Explain SS 600, division of responsibility, SS 706, explain OMP, and simple OMP that there are 8 subsidiaries which are audited by someone else, and 2 of them are in India, and 2 of them are outside India, 6 of them are in India. They contribute to so much of assets, so much of assets, so much of revenue, so much of cash flow. So simply explain through OMP that we did not audit them, nothing else. And we have done our audit based on their reports. And then they're talking about the two subsidiaries also. There's a complete paragraph over that. There's a complete paragraph over that. You also explain if the framework was different, how it was tackled. Whether it was tackled, we have just discussed option 1, option 2. We need to express in the audit report whether option 1 was used or option 2 was used. Two of the subsidiaries are located outside India. They are different framework. The holding company has converted, management has converted the financial statement of subsidiaries as per generally accepted accounting principles in India. We have audited those conversion adjustments. So they are explaining option 1 that we have done all the hard work. Our opinion is not modified. So guys, first they're explaining that okay, part of 8 subsidiaries are audited by someone else. They're first talking about 8 subsidiaries. Then they are talking about 2 foreign subsidiaries. 8 subsidiaries and then 2 foreign subsidiaries. Okay. It's an interesting question, guys. And now because it is directly in the new study material, as I was explaining that they will do the same thing, just put it in a case study format. And that's very lovely. And it's important to do such case studies. The theoretical knowledge which we just took about different type of reporting, they're giving a practical about it. That's a very important question. So they can simply convert anything into a practical case study. Now, let's talk about completeness. Let's talk about completeness. How will you check completeness? State the procedures. Very important. How will you check completeness? How will you ensure that all the components are covered? There's completeness. How will you check that? Now, there are 6 points out here. How will you check completeness? You should ensure that all the components are covered and no components are left out. Okay, let's understand this, guys. So first of all, it's in sequence. The first thing which comes to my mind is always the previous year. Then the current year comes. So first go to previous year. Go and review prior years. Go and review documents of previous years. How many components were there in the previous year? What was the relationship and how they were consolidated? And try to understand whether all those components are consolidated in the current year also. If not, what are the reasons and whether reasons are valid? Then go and understand parents' procedures of identifying all the components. What is their procedure of identifying the components? Whether they sit with the investment registers, how they sit with the investment registers and one by one they identify the subsidiaries and joint venture and associates. Whether they sit with all the legal contracts of joint ventures or all the contracts which give control over the board. So go and understand the procedures which are used, internal controls which are used for identifying the components, whether those procedures are reliable, are they adequate, and are they implemented properly. Do inquiries, like substantive procedures, do inquiries from management that whether you made any new investments, whether you made any new contracts, whether there are new investments, are there new agreements giving control over board of directors. Ask those questions and ask questions why this company is excluded. So first go with the previous year, then like test of control, go and check their procedures, and like substantive procedures, you go and do inquiry, and then you have to focus on the documents. 4 types of documents. Statutory records, they are registered, maintained Registers are maintained for investments. Registers are maintained under section 186, under one section 190. Then there are registers which give details of what kind of money is lent, what kind of investment is done. They can give you hint about the components. Then go and see the investment register. Statutory records, the biggest statutory record, then the investment register. Then for joint venture, go and get the joint venture agreements. Apart from that, other agreements like controlling the board, go and take that information also. So take statutory records, take investment records, take joint venture records, take other records which give the control. So 4 type of documents. Then always ask for change in shareholding. Changes in shareholding which have taken place, existing companies. So in some companies you may get the stake, controlling stake, and now it should be consolidated. And finally, document procedure performed for assessing completeness. Let's freeze, guys. First, so in total 6 points. First go to previous year, then go for the test of control, then go for substantive process inquiry. In substantive procedure, you can go for documents. There are 4 types of documents. The biggest one is statutory records, then investment registers, then joint venture agreements, other agreements. Go and check the shareholding and finally document how you have checked the completeness. Guys, important question. This can be targeted. This has been there in May 23 RTP, study material 23. Now, this question has been asked in May 23 mock, otherwise I would have removed this. Okay. This is the last question. This is the last question. Last question for the consolidation. Losses in subsidiary. See, once permanent consolidation adjustment is done, what we do every year we take profits and losses of the subsidiary and losses and profits of the subsidiary. If they're profits, we add to the P&L, our share we add to the P&L, and minority interest we add to the minority interest. Okay, that's what we keep doing. But if there is loss, if there's a loss, we will adjust loss in our reserves also, and we will adjust loss in the minority interest also. But then slowly time will come that minority interest will get eroded. It will go away. It will become zero. In that case, if there are further losses, see, be realistic. Minority interest is not going to give you money. You cannot show debit balance and receivable balance. So if there is an excess loss, if minority interest is becoming negative, that should be adjusted with our reserves only. That should be adjusted with our reserves only, because be realistic, we are not going to get money from them. So after permanent consolidation adjustment, every year we take profits and losses and adjust in our share in our reserves and rest in minority interest. If it's profits, fine. If it's losses will be adjusted. But moment minority interest becomes zero, we cannot show it MI as a negative and show receivable from minority interest. Okay. So simply explain this. Further, they have, okay, they're not talking about, consolidation. Okay, I gave you the whole knowledge about consolidation. They are talking simply about the investment accounting. They are simply talking about the investment accounting, guys. So basically, two of the subsidiaries' net worth has been eroded. Overall, in subsidiary there are not losses, but then in sub-subsidiaries there are losses. As per AS 13, accounting for investment issued by chartered. So it's very simple. So guys, I explained from the point of view of consolidation, but they're not talking about consolidation. They're talking about simply accounting of investments in subsidiary. As per AS 13, accounting for investment issued by Institute of Chartered Account of India, the carrying amount of locked in, you are supposed to make provisions, long-term provisions at cost, long-term investments are at cost, and if there's a diminution, then there should be provision for diminution. Okay guys, so just change the AS out here. AS 13, not AS 21. So it's very simple, straightforward. It's our basic knowledge and they're talking from the point of view of AS 13. If they talk about India's, they have not specified AS or India. It's an old question. You can definitely apply India's also. It will also go on the same lines. It's a very simple thing. We always keep our investments at cost. Investment subsidiaries are long-term investments. They will be kept at cost. If there are substantial losses, big losses, we have to make provision for that. We have to see individual investment and not the whole portfolio. When we do the accounting, we see individual investment and not the whole portfolio of the investment. Okay. So simply discuss the case, and we have to make provision and nothing more than that. We have to simply make the provision, guys. So guys, a lot of questions we have seen. Finally, we are through with consolidation. You can expect a lot of questions or MCQs from the consolidation. We have covered all the important ones from there. Now we have chapter number 14. We have chapter number 14, and chapter number 14 is the first part deals with audit of banks, and the second part deals with audit of NBFCs. Okay. Let's see, guys. Not now a very special, now a very simple question, but then we are taking it because it is there in study material. Anything which is in study material becomes important, and they have tendency to convert it into a case study. They have tendency to convert everything in the form of case study. So concept remains same. They simply convert it into form of case study. And if you have reasonable knowledge and you identify, okay, this concept is applicable, you will be able to crack it. So because of certain characteristics are distinguished from other commercial enterprises, hence its special audit consideration. As an auditor of bank, specify various peculiarities. What is so special in bank, because of which special audit consideration, different audit procedures are required in case of bank. What is so special? What is so special? How banks are different? What features, what characteristics are different from others, and that's why you need special audit procedures for them. So very simple shortcut is given. So there are new dawns in the banking sector. So you can say dawns means factors. There are new dawns, there are new challenges in the banking sector, and for that you need different audit procedures, separate audit procedures, special audit considerations. So new products and services. Banks on continuous basis, they come up with new products and services. They launch a lot of different credit cards, they have cashbacks, they have reward points. They come up with credit cards, debit cards, UPIs, lot of new products and services continuously. Because there are a lot of new products and services on continuous basis, they are new challenge. Because of that, you need new accounting policies for them. The new products and services, you need a detailed analysis and new accounting policies and principles. So it may happen that those accounting policies and principles are not developed, or they are developed in the haste, and they may not be appropriate. That's a big challenge because of new kind of products and services all the time, all the time. So you need new different accounting policies, new way of accounting policies all the time. That's a different thing in bank. So if there are reward points which are never going to expire, how to make provision for them? Should we go for 100% provision, or should we go for past experience? How should we see past experience? There are a lot of questions. How the accounting policy and accounting treatment should be there. That's a unique thing. Then dependence on IT. Banks are excessively dependent on information technology. Everything is automated based on IT. Receipts, payments, credit card, debit cards, online payments, UPI, NEFT, RTGS, everything is online. So focusing on the IT infrastructure becomes very important and special in banks. The scale of banking operation is huge. The scale of banking operation is huge. It is so huge, even a small error, a small issue can blow up into a very big thing in short period of time. There are huge receipts and payments, large number of branches, large number of customers. Any problem, any issue is going to blow up at a very fast rate. So if there is any system issue, it should be taken very, very, very seriously. There is a big chance that any deficiency becomes significant deficiency in case of bank. The nature of risk is different. There are a lot of cash balance. So cash balance, cash movement. So there's a lot of risk of theft. There's a lot of assets in the locker. Again, threat. There's huge investment. There's a valuation threat. So there's because of the cash and other things, there's a threat of the theft, and because of investment, there's always a risk in the valuation. S stand for statutory and regulatory requirement are different. There's a capital adequacy ratio, NPA norms. So guys, you talk about dons, new products and services, dependency on IT, operations are on huge scale, nature of risk is different, statutory and regulatory requirements are different. And dependence of IT we have already explained. Because of this, the auditor should consider effect of above factors designing audit approach. It is imperative for branch auditor and statutory central auditor to have detailed knowledge of the product services, and because of this, there will be a huge increase in risk at financial statement level. Because of these things, anywhere things can go wrong. So these factors lead to increase in financial statement level risk, and auditor need to be alert. The whole team need to be alert and careful about it. That's the first question. What is so special in banks? So new dawns is a special thing. So this question was there. This question was there in May 23 mock paper. This question was there in study material 23. So a very simple thing. You're auditing a small branch. Staff strength of manager, cashier, and 3 other staff. So there is one manager, there is one cashier, and there are 3 other staff, S1, S2, S3. So in totality, there is a very small branch with only 5 staff members. Only 5 staff members. Among allocation of work of other areas, S1, who is a peon, also opens all the mail and forward it to the concerned person. So S1 is a peon, does the office, it's an office boy, done all the basic things, and he only opens the mail and forward it to the concerned person. He does not have signature book so as to check the signatures on the important communication. S2 has possession of all the bank forms, checkbook form, demand draft, pay order books, traveler's checks, foreign currency card, etc. He maintains a record meticulously which have test checked also. He only maintains the record. He has the custody of all the bank forms, and he only maintains the record also. S1 is not having signature book. However, no one among the staff regularly checks that. You are informed that being a small branch with shorter manpower, it is not possible always to check and work records. So, it's bank responsible to implement and maintain, design, implement, maintain good internal control system. Good internal control system, it is their responsibility. Now, this one, the person who opens the mail and forwards it to concerned person does not have signature book, so that he can check whether the checks and all the documents, check the signatures on important communication are not in accordance with implementation and maintenance of general internal control. As the mail should be opened by responsible as received, other branches should be checked by officer with signature book. So a person with a good knowledge level and skills should have been opening those mails, and peon can come, he can sort and he can present, but it should be opened by a responsible person. So the competence of the person is not appropriate for the job, and signature book is very important. Any communication is valid, acceptable and processed only when there is appropriate signature. If there is no appropriate signature, those documents will be further investigated, they will not be processed immediately. Then all the bank forms should be kept in possession of an officer and another person should verify the issuance. So this is first problem with S1, and this is problem with S2, that the person who is maintaining all the forms, that person only maintaining all the records. If the same person is having custody of the asset and custody of the records, manipulation can be done easily and adjustments can be done and no one will understand it. Further, the contention that it's a small branch and there's a shortage is not tenable. There are 5 people, try to handle it. Okay. The auditor should report the same in his. Let's see, guys. So, what limit is enjoying cash credit facility sanctioned from Nariman Point Mumbai branch of KNB Bank? So, this is a question of cash credit facility, and sanction 250 crore is the limit. However, practical consideration, various sub-limits have been fixed for borrower company for operations at Solapur, Pune and Nashik branches. So there is one overall limit of 250 crores, but for different locations, there is a different limit of same bank. The manager of Solapur notices that there are no credit transaction in sub-limit account being operated at Solapur branch for more than 90 days. Very interesting question. May 23 RTP, it was there. There are no credit transactions. Discuss approach of CA Muni, statutory auditor of Nariman Point branch, in the matter of asset classification of the above borrower account. Also discuss consideration for classification of the said Solapur branch. See, sometime a customer is sanctioned a cash credit limit at one branch but is authorized to utilize such overall limit at several other branches. So what is happening here is, let's see. So the Mumbai branch has submitted all the documents, everything, and they got the limit of 250 crores. So they said that, okay, you split this limit and give it to different branches. Solapur branch, Pune branch, Nashik branch. So these 3 cities, you distribute the limits in these 3 cities also. So when it comes to NPA determination, should we do it? Should the NPA determination should be done at branch level? The question is, The determination of status of account as NPA or otherwise should be determined at sanctioning branch with reference to overall sanction limit and not by each of the other branches where the sublimit has been fixed. The auditor of the limit sanctioning branch should examine whether it receives particulars of all transaction account at sub branch and whether status of the account has been determined and considering total position of operations of all account. The standalone matter, no credit transaction more than 90 days is irrelevant. Keeping this in point, details of all concerned branches should be taken together. Regarding sublimited branches, the classification adopted by limit sanctioning branch should be followed. Hence, the Solapur branch has now followed asset classification made by the limit sanctioning branch. So let's understand, guys, it's very simple, straightforward. Asked first time in May 23 RTP. So what is this case all about? It's very simple case, guys. But then if you have solved it once, then only you will be able to crack it. Okay? Because this is not straight away on any particular, on a particular exactly pinpoint concept of the module. So very simple thing is there. There's a Mumbai branch and this is Pune, Solapur and Nashik. Mumbai branch is limit sanctioning branch. So Mumbai branch has taken CC limit and it has CC limit of 250 crores and then it has provided to Pune, Solapur and Nashik. Okay. In case of CC limit, we have this concept. If the amount is crossing the limit for continuously 90 days, it is there's a concept of out of order. Then it's out of order NPA. If it's not crossing, but there are no credits, it is NPA, out of order NPA. If the credits are not covering even the interest amount, the money deposited is not covering the interest amount, again NPA. So now the question is, we have to check the NPA status. Should we check it at the branch level, at Pune level? Are we supposed to check it at Pune level, Solapur level, Nashik level, or we are to check it at the limit sanctioning branch level, limit sanctioning level? So they have said that you have to go and see which branch has taken the overall limit. And you have to check the status at that particular branch. When we talk about that particular branch, they will take into consideration data of that branch and all the sublimits. What is the overall consumption of the limits? What is the overall credits? What is the overall credits? What is the, whether we are covering the interest? This will be seen at sanctioning branch collecting all the data. And whatever they decide, it should be followed by the branches also. So that is the whole crux. So explain, I will say that first explain that in CC limit, how there is a concept of out of order and NPA. Then you explain how there is limit sanctioning branch and other branches, and we have to focus on the limit sanctioning branch, and as per that limit sanctioning branch, it will collect all the data, see the overall view, and that will be followed by everyone. You discuss the case and then conclusion. Simply follow limit sanctioning branch, that is the conclusion. Okay, because only they are in the position to see a total point of view. They are in the position to see total point of view. So a lovely case, a good case, it can be asked in exams, guys. Again, a question which came in study material 21 and now it is there in study material 23 also, guys. There is, as far as I see, there is a very simple requirement. This very simple requirement. Suppose anyone has taken any CC limit, crash rate limit, or OD limit they have taken. It is generally for a year. It is generally for the year. Okay. As the year gets over, borrower is supposed to submit all the documents again. And get the limit renewed. If this is not done within 180 days from the due date, then that particular account will become NPA. That will be classified as NPA. So that's what is happening out here. Renewal was due on 1st of September. 1st of September. September, October, November, December, Jan, Feb, March. It's almost 7 months. Till 31st of March 2020, renewal is not done. The account is operated regularly and is ordered. Renewal, money is regularly deposited. There is no issue with that. It is within the limits. There are regular debits. There are regular credits. There is sudden death of the auditor. In case of borrower, a new auditor has to be appointed. So basically borrower's auditor passed away. So audited financial statements were not ready. Audited financial statements till 31st of March, the limit was not renewed. They got audited financial statement 10th of April and renewal letter was issued immediately. Your assistant is insisting that account should be classified as NPA immediately. As per guidelines, NPA if renewal is not done within 180 days. Operation in the account are excellent. There are certain reasons the audited financial statement have been delayed. There are genuine reasons. The limit has been renewed before signing the audit report. It is an adjusting event as per AS4. So guys, there are two twists in it. The first twist is you need to explain that, first explain that accounts, the renewal, explain the renewal criteria. And therein you explain that in case of renewal criteria, guys, it should be done within 180 days. It should be done within 180 days. Even if the operations are happening properly, even if you are getting money on regular basis, even if the limit is not crossed, everything, the criteria of 180 days is very important. So as per that, it should be NPA. But you were having a status of NPA as on 31st March. But there was a genuine letter, and before the accounts are finalized, that letter is received, that audited financial statements are received, procedure is complete, and renewal has happened. We explain renewal criteria. Then you explain the case. Then you focus on that, okay, position as on balance sheet date is clarified. It is an adjusting event. Position as on balance sheet date is clarified. It is an adjusting event. It is an adjusting event. We'll consider the effect. Positive effect, because adjusting event can have a favorable effect also and unfavorable effect also. So here we are getting more clarity with respect to situation which was existing as on balance sheet date. Because renewal is done, let's be reasonable, let's be realistic. It should be, conclusion, it should be a standard asset. It should be a standard asset, guys. Beautiful case, lovely case. If you have done these things at least once, then everything will be fine, guys. Then you can crack it. But at least once, such cases should be done one time. Then again, we have study material 23 case. The bank follows financial year as accounting year. That's fine. There is a credit facility of 50 crores to X Limited. Bank's own share is 10 crores only. There is a consortium. When two or more banks give credit finance facility together, that's called consortium. During the last 2 quarters, against debit of rupees 1.7 crores towards interest, only credit of 1.25 crores only. Based on the certificate of lead bank, the bank has classified the account as performing. Give your views. Give your views on this matter. That the amount remains outstanding and thus interest amount should be reversed. This is despite the certificate from the lead bank to classify the account as performing. Now listen, guys. Let's understand. In consortium, first you need to explain the consortium. What is consortium finance? So 2 or more banks giving a finance, that's consortium finance. There's a lead bank which gives the major share, and the other are participating branches. All the administrative work is done by the lead branch, and participative branches get the statements and their share from the lead branch only. Role of lead branch. NPA criteria is very simple. Everyone has to focus. Everyone has to focus on their own status of recovery. And depending on that, everyone will independently decide whether their accounts are in NPA or not. So, NPA criteria independently decide. Individual bank will decide it. Okay. Now, if individual bank is not getting money, we know for cash credit, if amount is crossing the limit for continuously 90 days NPA, if it is within the limit but no credits for 90 days NPA, continuous 90 days NPA, if credits are less than the debits, then again NPA. Now, if you see module theory, they say that They have here they have said that only a letter is there from the lead bank. There is a certificate on the lead bank. They have not given all the details. What kind of certificate is it? Just because of certificate, we cannot. A simple letter or certificate is not going to have impact. We'll go with the NPA. We'll go with the NPA, and as account becomes NPA, we'll reverse the accrued interest. Now, guys, if you see module theory, they specify. If you see module theory, guys, they specify one thing. What thing they specify? That if lead bank has received money and there are only procedural issues, money is not yet given, and if money is received after 31st of March before finalization, then it can protect a bank from NPA. But they have not given all these details. So simple letter is not going to work. If all the details are given, a lot of positive things are there, then that bank can be protected. That bank can be protected from NPA, because here no details are given. There is no protection. It will be treated as NPA. Everyone has to look into their own criteria, guys. Again, a lovely case has been asked in study material, asked a lot of times, and it is there in the study material as well. Okay. Let's see one more question. CA Harshit is conducting statutory audit of branch public sector bank. 20 large advances, find 5 examined cases. Loan application has been filled up scantily with important details left out. So these are large advances, 5 cases. Loan application is not filled properly. Cash credit to the borrowers were enhanced during the year but no records. Basically, procedural work is not done properly. No records pertaining to the assessment of the enhanced working capital requirement in respect of borrower files. The branch is unable to show such assessment workings in the system either. The branch is unable to show such assessment and workings. So there are no proper records, there are no proper records, there are no proper documents. Okay, there's a big issue, that's a big challenge. However, all 5 accounts are operating satisfactorily. So there's a problem with documentation. How the working capital requirement, every quarter you need working capital details so that drawing power can be calculated. Guys, so in this particular case, no records pertaining to assessment of enhanced working capital requirements. Okay, let's understand this, guys, what they're saying. They're saying that loan was not given properly, credit appraisal was not done properly, loan document application was not done properly. There's a problem with the credit appraisal. And further, the limits were enhanced. There's a problem with the limit enhancements also. There were no proper documents for the limits enhancements. So documentation, the credit appraisal while giving loan, while increasing the limits is weak. There's lack of documentation also to support it. And they're saying that if there's a problem with the credit appraisal, it should be reported. There's a problem with internal controls. In long form audit report, you comment on the internal working of the departments you comment that credit approval process is not proper, there's a problem with the approval process, applications and enhancement of the credit limits. Okay, so it is not going to affect NPA, classification is going to remain as it was. But guys, further, there is no adequate details. There's one more thing, but there are no details about it, there is no discussion about it. So institute has left that point, institute has ignored that point, institute has left that point and institute has ignored that particular point. What is that particular point? That if stock statement is older than 3 months, but they're not talking about it, so there's no discussion, but I'm saying as a knowledge, if stock statement is older than 3 months, accounts become irregular. And if such things continues for more than 90 days, then it becomes NPA. So if there is no proper stock statement, even that can lead to NPA. But then here they are not talking about the stock statements at all. They are only talking about working capital, enhanced working capital requirement. They are not talking about regular stock statements. So you can always give a note, they are not talking about stock statements, so we are not applying the criteria of stock statements, which again leads to NPA. You can always give it as a note. Okay. Quickly guys, one more question. One more question, again NPA, it is there in study material 23. Fulfillment of criteria prescribed for NPA for government guaranteed advances given for agriculture purpose, drawing power, stock statement respect of working capital accounts, ad hoc limit not. Okay, one by one guys. Regarding government guarantee, if there is a central government guarantee and if that guarantee is not revoked, it's not cancelled, it is not challenged, it will give protection from NPA. Such accounts will not become NPA. No need to make provision for NPA. But if there is a state government guarantee is not of any use. It cannot protect any account from NPA. When it comes to agriculture advances, we have to see whether this advance is for long duration crop or short duration crop. Something which takes more than a year is a long duration crop, up to 1 year is a short duration crop. In case of long duration crop, after due date, bank has to wait for 1 crop season. And if money is not received, it will be termed as NPA. In short duration crop, we have to wait for 2 crop season. And there is a state level banking committee which explains in each state what are different crops, when the season starts, when the financing should be done, what should be due date, and so on. In drawing power calculation, you need every quarter you need a stock statement, debtors, creditors for drawing power calculation. If the stock statement with the bank is older than 3 months, that accounts become irregular. And if such things continues for more than 90 days, it will become NPA. So, drawing power needs to be calculated properly. And if it's more than 90, it will become NPA. In big accounts where crores of limit is there, even a stock audit is conducted. So a CA firm is appointed for stock audit. And this drawing power is extremely important. So I will say that you explain all the points. They have not explained it, that how the drawing power is calculated, how the statement should come, otherwise it will become NPA. You explain for big accounts, you go for stock audit. You explain that drawing power plays an important role. Limit not reviewed, we have just discussed. If the limit is not reviewed within 180 days, if the renewal process doesn't happen within 180 days, after due date, then it will become NPA. Further, if a ad hoc limit, ad hoc is temporary limit, if ad hoc limit is again, if ad hoc limit is not, if ad hoc limit is not again reviewed within 180 days, it will become NPA. Again, guys, they are focusing on the same thing. November 22 RTP. Last question quickly. Enjoying overdraft facility of 50 crores. Overdraft facility is 55.65 crores. It is crossing the limit as on 31st of March. Monthly, it should be submitted. Latest available is Feb 22. Showed drawing power of 48.50 crore only. Stock audit of borrower was also conducted. One of the impaneled stock auditors. Stock audit report 31st December placed on the record commented adversely on the declining turnover. There is a declining turnover. The renewal of draft is on due on 20th of October 2021. The account was short renewed by competent authority for a period of 3 months. Pending submission. Short renewed means renewed for a shorter period. Not submitted proper things till 2022. There is a request letter from borrower on record stating that the valuation report of property located at a faraway location was taking time. The branch has classified it as a standard asset. Give your comments. Now listen guys. Here, be careful guys. If the limit is crossed for continuously 90 days, it will become NPA. Okay. The balance was above the limit only for 1 month. So only for 1 month, that is 30 days, not NPA. If the statement is older than 3 months, it will become irregular, and if it continues for 90 days, it will become NPA. Statement is of Feb 22. It is a latest statement. We understand there are deficiencies, but then these deficiencies are within the time limits. Absolutely fine. Stock auditor says that there is a problem with turnover. That is not a criteria for NPA. Renewal is done. Short renewal is done. If no renewal is done within 180 days, it is done. October, so November, December, January. Till January, renewal is done. After January, 180 days has not crossed as on March, Feb, March. So there are deficiencies, there are issues, but all of them are within limits. And because all of them are within limits, guys, it should not be classified as NPA. Standard asset is absolutely fine. Okay. Guys, we'll stop here. Tomorrow we'll complete this. We'll complete this chapter. Guys, do like, subscribe, share with your colleagues, and do put your lovely comments. That matters a lot.